So today's question, we're going to be looking at what assets Property Partner have available and why they tend to kind of focus on them within the property kind of sphere. So I guess what are the main elements that Property Partner are focusing on at the moment?
This is it's basically a product of how we evolved. So we started off in residential. That was the principal driving force of the founder. But that's I said to him early on, we'll do individual assets, but really we want to be offering blocks and a product that the typical buy-to-let investor can't get their hands on. So it'd be the block of six flats rather than just one, or block of 10 flats. The largest one I think we've got is 42 flats up in Gainsborough. We've got the freehold of the building, and this is key because you don't have the ground rent. You control the service charge because you've still got to maintain the block, but you decide when you're going to do the maintenance rather than be beholden to somebody else setting the budgets for you. And that is a key component part of your gross and net performance, the service charge element. I see examples of flats in the Docklands where the service charge there is like £40,000 a year. That's ridiculous. You struggle to think what they're spending the money on.
There's a lot of lifts and a lot of gyms.
Well, they say you've got spaces. You can get a lifetime membership for a gym for that, So what about the other year? So we control that, and that's what we aim to do. But, in the individuals we don't, but we're careful what the service charge budget is, and if it's a silly one, we don't touch it. If it's a crazy ground rent, I've seen these ones where they've introduced doubling of ground rents every 10 years. Very quickly, that will get out of control and impact on value. So we're very careful about that sort of thing. So we've morphed into residential blocks, and that's the core offering, and with debt. And then, as I sensed a slight slowing down in the residential growth to more moderate levels, I thought it'd be great to actually have a sort of a diversified offering, an income product. And harking back to my days at Savills, where we did bespoke student accommodation. I've always kept a keen eye on it and persuaded the management team that we should be doing this. And we did. So we offered our first student block in September 2017, which we were very nervous. It was a very large offering, and we had the mantra that increase the size. Investors don't increase the check size. Well, that was completely wrong. It was a very big raise. It was fully funded in the first day. It was 2 times overfunded within a week.
Why do you think that was? Is it because of the slightly different offering from what the platform had?
Yes, it was a very complementary offering. It was a strong yield where residential typical net dividends on our platform, which isn't a yield by the way, is around about 3%. A typical student net dividend is 6%.
Okay.
I'd stress it's a dividend, which is the calculation of income after all costs and tax. On your investment, which is not only the purchase price but your cost of purchasing, which people talk about yield, which is very different, and so you get a much higher number on yield.
Different comparisons, isn't it? Absolutely. Okay.
And I think there's a lot of connection on a personal level. Speaking to our investors, they've all either been in these halls or they've got their kids are there, and they know what a struggle it is to get accommodation. So a lot of awareness and comfortable with the asset class. It is still quasi-residential, heads on pillows. So yes, so it went very well, and so we did a lot of that over the course of this year, and still seem to be majoring on it.
So started residential kind of core, and then moved into the purpose-built sort of student accommodation. Any other asset classes that you tend to focus on?
And then at the beginning this year, again adding to diversification and income, we added a Sainsbury's convenience store. Okay. I think it was a 15-year lease, so that's 15 years. Index-linked income with a Sainsbury's covenant, which is for me really good. If you've got to think about long-term safe money, sort of pensions or style money, that's a good place for that kind of where to go. The growth is income. The growth is derived either from yield compression if people take a view on that they think they value the income higher, so that adds to the value, or just the rental growth. As the rental growth goes, so does the capital value grow with it.
So nice diversity across different asset classes.
Absolutely.
And are you seeing? Was it kind of a snapshot as in maybe the property cycle that we're in at the moment, you saw those opportunities as well, or is it just a general all-encompassing? It's good to have a blend.
It's good to have those assets. My suspicions on headwinds for residential were a very key driver for doing student at the time, to have a second string to the bow and a very complementary asset, and that's proved to be absolutely right. again, because you know, if you get a market where, back to the early 2000s, where it's going up 3% a month, students are going to look very dull, and you know, residential is going to be key. So it's actually having the right product for the right time where we are. Where we are at the moment it's a very slow market, so we're actually looking for very hard deals where we can drive a solid bargain and take time about it. You know, I use the adage: there's nothing better being a cash purchaser in a recession. And, this isn't a recession, but it's a slower market for sure, and we want to make our investors' cash work well.
Absolutely, sounds good. Thank you very much.